In the noisy and impatient world of stock markets, where traders chase quick profits and headlines scream about daily ups and downs, value investing stands quietly in the corner. It does not promise to make you rich overnight. It promises something better. It promises wealth that lasts. Christopher Browne begins this little book with a simple but powerful truth. Investing is not gambling. It is not luck. It is not about predicting tomorrow. It is about buying good businesses at fair prices and holding them until their true worth is recognized. This is the foundation of value investing. It sounds simple, and it is. But simplicity is often the hardest thing for people to follow. He reminds us that the stock market is not a mysterious machine. It is a collection of real businesses run by real people, selling real products to real customers. When you buy a share, you become a part owner of that business. Most investors forget this. They treat stocks like lottery tickets. They panic when prices fall and get greedy when prices rise. Value investors do the opposite. They stay calm, rational, and patient. Value investing is like buying a house. You do not care what your neighbor's house sells for every day. You care about the location, the condition, and the long-term value. The same logic applies to stocks. If a company is strong, well-managed, and selling for less than it's worth, that is a bargain. Over time, the market will correct its mistake, and the investor will be rewarded. Browne also explains that value investing is not new. It was born from the wisdom of Benjamin Graham, the father of value investing, and later practiced and perfected by Warren Buffett. These men showed that investing based on discipline and logic beats speculation and emotion. They proved it over decades, not days. But why does everyone not follow it? Because it requires patience, discipline, and the ability to go against the crowd. The crowd wants excitement. The value investor wants results. The crowd chases fashion. The value investor looks for timeless value. The crowd buys what is popular. The value investor buys what is ignored. In this book, Browne breaks down this philosophy into clear steps. He shows how to calculate value, how to find bargains, how to avoid traps, and how to think like a true investor. Each chapter takes you deeper into the mindset that separates winners from losers in the long run. He tells you that successful investing is not about predicting the future. It is about understanding the present. When you understand what a company is worth today and buy it for less, you already have your margin of safety. That margin is your protection against mistakes, panic, and bad luck. The introduction ends with a simple reminder. The market may be unpredictable in the short term, but human nature never changes. Fear and greed will always rule the crowd. A value investor learns to rise above both. So as you step into the next part of this book, keep one thought in mind. The power of value investing lies in its simplicity. It is not about being faster. It is about being wiser. The next chapter will begin your journey into understanding exactly what value investing is and how it can quietly build a fortune over time. Part 1. The Basics of Value Investing. Introduction. Part 1 of this book lays the foundation for everything a value investor needs to know. Before diving into financial statements, ratios, and stock picks, it is crucial to understand the mindset and principles that guide every decision in value investing. Christopher Browne emphasizes that value investing is not about chasing hot tips or reacting to daily market noise. It is about discipline, patience, and careful observation. The basics are simple but powerful. They involve understanding the true worth of a company, knowing how to spot bargains, and resisting the urge to follow the crowd. At its core, value investing requires seeing the difference between price and value. Price is what you pay today. Value is what the business is really worth over the long term. Most investors focus only on price and short-term movements. Value investors focus on value, which allows them to act calmly even when the market panics. Browne also introduces the concept of margin of safety, a cornerstone of value investing. By buying a company for less than its intrinsic value, investors protect themselves from mistakes, market fluctuations, and unforeseen risks. This simple principle separates successful investors from those who lose money chasing trends. Another key lesson in this part is understanding the behavior of Mr. Market. The market can be irrational, often swinging between optimism and fear. A value investor does not get swept away. Instead, they use Mr. Market's mood swings to their advantage, buying when others are fearful and selling when others are greedy. Finally, Part 1 sets the stage for the practical tools and strategies that follow. It establishes the mindset required to interpret financial statements, evaluate earnings, and make intelligent investment choices. Without mastering these basics, even the most sophisticated analysis will fail. As we move to the next chapter, you will begin to explore exactly what value investing is, why it works, and how it differs from the speculative approach that dominates most investing today. Understanding this distinction is the first step toward making money in a rational, disciplined, and long-lasting way. Chapter 1. What is value investing? Value investing is more than just a strategy. It is a philosophy, a way of thinking about money, risk, and the stock market. Christopher Browne begins this chapter by explaining that most people treat the stock market as a place to make quick money. They focus on what stocks are doing today, yesterday, or what analysts predict for tomorrow. Value investing takes the opposite approach. It is about looking beyond daily price movements and finding the true worth of a company. At its heart, value investing is simple. You buy shares of companies that are undervalued by the market. In other words, you buy $1 for less than $1. But simple does not mean easy. The market is full of distractions, emotions, and short-term thinking. A value investor must remain disciplined and patient, ignoring what the crowd is doing and focusing on the underlying business. Browne stresses that value investing is not about predicting the future or timing the market. It is about understanding the present. When you know what a company is really worth, you can make informed decisions without worrying about daily price swings. This approach reduces risk and increases the probability of long-term gains. He introduces the concept of intrinsic value, which is the actual worth of a business based on its assets, earnings, and growth potential. Unlike stock price, which can fluctuate wildly due to fear and greed, intrinsic value is steady. A value investor compares the price of a stock to its intrinsic value. If the stock is priced lower than what it is worth, it becomes a buying opportunity. Browne also explains the importance of margin of safety. This means buying with a buffer, so that even if the market makes mistakes or unexpected events occur, the investment remains protected. For example, if you determine a company is worth $100 per share, buying it at $60 or $70 provides a margin of safety. This principle is a key reason why value investing has outperformed other strategies over time. Another important idea in this chapter is patience. Value investing is not exciting or fast. It requires waiting for the market to recognize the true value of a company. The crowd often reacts emotionally to short-term news, but value investors remain calm and rational. They know that time works in their favor. Browne contrasts value investing with speculation. Speculators chase trends, rumors, and hype, hoping to sell to someone else at a higher price. Value investors focus on businesses with strong fundamentals. This difference in mindset separates successful investors from those who lose money trying to be lucky. Finally, the chapter sets the stage for understanding how to measure value in practical terms. Browne hints that the next step is learning how to determine what a company is worth and how to spot bargains. By mastering this, an investor can make decisions that are logical, disciplined, and likely to succeed over the long run. Chapter 2. What's it worth? In this chapter, Christopher Browne dives deeper into the core idea of value investing, determining the true worth of a company. Many investors look at stock prices and think they reflect value. They do not. Prices are influenced by fear, greed, rumors, and short-term events. Value investing focuses on intrinsic value, what a business is genuinely worth, independent of market swings. Browne explains that intrinsic value is based on tangible assets, earnings power, and growth potential. A company with strong products, loyal customers, and efficient management has value that the market may not fully recognize. The key is to separate price from value. Price is what you pay. Value is what you get. Paying less than value creates opportunities for long-term profit. He emphasizes that determining value is both art and science. It involves looking at financial statements, understanding how the business makes money, and projecting future earnings. But it also requires judgment. No formula can predict exactly what a company is worth. Experienced investors use a combination of numbers and intuition to estimate value. One of the most important tools in assessing value is understanding cash flow. Cash is the life of a business. Earnings on paper can be misleading due to accounting adjustments, one-time charges, or creative bookkeeping. Cash flow reveals whether a company can sustain operations, pay dividends, and reinvest in growth. A business generating steady cash flow is far more valuable than one showing profits that may not materialize in cash. Browne also warns about overpaying for growth. High growth companies can be tempting because their stock price rises quickly. But paying too much erases the margin of safety. Even a small error in estimating value can lead to losses. Value investors prefer companies with solid fundamentals and a price that allows them to profit even if growth is slower than expected. Another lesson is avoiding the influence of market sentiment. Stocks often swing far above or below intrinsic value due to fear and greed. A smart investor looks past these swings, focusing on whether the business itself is strong. Market panic can create bargains, while euphoria can create traps. Recognizing these opportunities is part of determining true worth. Browne also introduces the idea of patience. Knowing what a stock is worth is only half the battle. The market may take time to recognize that worth. Investors must be willing to wait without selling in a panic or buying in a frenzy. Time is a friend in value investing, not the enemy. Finally, the chapter reinforces the importance of margin of safety. Even with careful calculations, mistakes can happen. Buying at a price well below estimated value provides a buffer against errors, market swings, or unexpected challenges. This principle reduces risk and increases the likelihood of consistent long-term returns. By the end of this chapter, the reader begins to understand that successful investing is not about guessing the next hot stock. It is about careful analysis, discipline, and patience. Understanding what a company is really worth sets the stage for the next step, finding bargains in the market where price is far below value. Chapter 3. Buy $1 for 66 cents. Chapter 3 introduces one of the most important principles in value investing. Always buy below intrinsic value. Christopher Browne calls this buying $1 for 66 cents. It is simple in concept, but powerful in practice. By paying less than what a business is truly worth, you create a margin of safety that protects your investment and increases the potential for profit. Browne explains that markets often misprice stocks. Fear, greed, and short-term events can push prices well below or above their actual value. Most investors panic when prices fall and buy when prices rise. Value investors do the opposite. They see falling prices as opportunities and rising prices as a warning. The key is to focus on the business itself, not the daily fluctuations of the stock market. The chapter emphasizes patience. A bargain is not always obvious, and it may take time for the market to recognize value. Buying a stock at a discount requires discipline and courage, because others may be selling in panic or ignoring the opportunity entirely. The value investor must remain calm and rational, knowing that the market will eventually correct its errors. Browne also highlights the concept of intrinsic value in this context. To buy $1 for 66 cents, you must first know what $1 is worth. This requires careful analysis of a company's financial statements, assets, earnings, and growth prospects. Once you have estimated intrinsic value, you can compare it to the current price. A significant gap between price and value is where the opportunity lies. Another lesson in this chapter is avoiding overpaying for growth. Many investors are tempted to chase companies that seem to be growing rapidly, but high growth does not always equal value. If you pay too much, even strong growth cannot protect you from losses. Value investors prefer companies with solid fundamentals available at a price that allows profit even if growth slows. Browne also stresses the importance of long-term thinking. Buying at a discount is not a short-term gamble. The market may take months or years to recognize the true value of a company. A patient investor benefits from compounding returns and the eventual correction of market mispricing. The chapter introduces real-world examples of bargains. Browne shares stories of investors who bought high-quality businesses at low prices and saw their investments grow steadily over time. These examples illustrate how the principle of buying below value can work repeatedly, provided discipline and research are applied. Finally, Browne warns against the temptation to follow the crowd. Popular stocks may rise quickly, but they often lack a margin of safety. Value investing is about resisting hype and focusing on the true worth of the business. This mindset allows investors to protect themselves from risk and benefit from opportunities others overlook. By the end of this chapter, readers understand that value investing is not about chasing trends or hot tips. It is about identifying opportunities where price is far below value and having the patience and courage to act. With this principle in mind, the next step is learning how to stay calm during market hysteria and not be swayed by the emotions of the crowd. Chapter 4. Don't buy Mr. Market's hysteria. In this chapter, Christopher Browne explains one of the most important lessons for any investor. Never let the emotions of the market control your decisions. He introduces the famous concept of Mr. Market, originally from Benjamin Graham, which personifies the stock market as a moody partner who offers to buy or sell shares every day at wildly changing prices. Sometimes he is euphoric, offering high prices. Other times, he is fearful, offering rock-bottom prices. The key is to understand that Mr. Market's mood swings are not a reflection of a company's true value. Browne emphasizes that most investors make the mistake of reacting to Mr. Market. They panic and sell when price is full, or get greedy and buy when prices rise. This emotional behavior often leads to poor decisions, losses, and missed opportunities. Value investors, on the other hand, see these mood swings as opportunities. When Mr. Market is overly pessimistic, stocks can be purchased at a discount. When he is overly optimistic, it may be time to sell or hold, depending on value. The chapter also highlights the role of patience. Mr. Market may remain irrational for long periods. Prices can stay below or above intrinsic value for months or even years. A disciplined investor must resist the urge to act based on daily fluctuations and instead focus on the fundamentals of the business. Over time, the market corrects its mistakes, rewarding those who remain patient. Browne provides examples of investors who ignored market hysteria and prospered. One story describes how investors bought shares during a market panic when prices were far below intrinsic value. Years later, as the market recovered, these investors saw substantial gains, while those who followed the crowd missed the opportunity. These real-life cases illustrate that acting contrary to hysteria is often the most profitable approach. Another lesson in this chapter is the danger of short-term thinking. Investors often believe that they must respond quickly to market news, rumors, or sudden price changes. Value investing teaches that time is an ally. Understanding the underlying business and its long-term prospects is far more important than reacting to daily price movements. The market may appear irrational in the short term, but over time, price and value tend to converge. Browne also explains how to maintain emotional discipline. Writing down a plan, focusing on intrinsic value, and ignoring noise are practical ways to prevent emotional reactions. By doing so, investors can avoid panic selling, impulsive buying, and other mistakes that harm returns. Finally, the chapter emphasizes that value investing is not about being popular or following trends. It is about being rational, patient, and disciplined. Investors who can resist the hysteria of Mr. Market are the ones who build lasting wealth. By the end of this chapter, the reader understands that the market's emotions are irrelevant to value. What matters is the real worth of a company. Armed with this understanding, the next chapter will reveal the secret to making money in stocks consistently by combining knowledge, discipline, and patience. Chapter 5. The secret to making money in stocks. In this chapter, Christopher Browne reveals what he calls the secret to making money in stocks. Many investors search for complex strategies, hot tips, or predictions about the future. Browne argues that the secret is much simpler. Focus on value, be patient, and maintain discipline. Making money in the stock market is not about speed or luck. It is about understanding what you own, buying at the right price, and holding for the long term. Browne begins by reinforcing the concept of intrinsic value. Every stock represents a share in a real business, and its true worth depends on the company's fundamentals. Investors who concentrate on value rather than short-term price movements have a much higher chance of success. This is the foundation of making money consistently. When you buy a stock for less than it is worth, you already have an edge. Over time, the market recognizes the company's true value, and your profit grows naturally. The chapter also emphasizes patience. Value investing requires waiting for opportunities and giving your investments time to mature. Unlike speculation, where quick gains are the goal, value investing relies on the market correcting its mistakes. Browne notes that impatience is the greatest enemy of investors. Those who sell too soon or jump on trends often miss the real gains that come from long-term ownership of undervalued businesses. Another key point is risk management. Successful investing is not about avoiding all losses. It is about protecting yourself from permanent loss of capital. By buying with a margin of safety and staying disciplined, investors minimize risk and maximize potential returns. Browne stresses that avoiding panic during market downturns is crucial. Falling prices are often opportunities, not threats. Browne also discusses the importance of ignoring the crowd. Many investors make decisions based on popular opinion, headlines, or market rumors. Value investors do the opposite. They focus on the business, not the market noise. By thinking independently and resisting herd mentality, investors can uncover opportunities that others overlook. The chapter introduces the idea of compounding. Small gains made consistently over time grow into significant wealth. By reinvesting profits and holding high-quality businesses purchased at a discount, value investors allow the power of compounding to work in their favor. This is how patient investors achieve extraordinary results over decades. Finally, Browne highlights discipline as the ultimate secret. Successful investing is not glamorous. It does not require luck or clever tricks. It requires careful analysis, a focus on fundamentals, patience, and emotional control. Investors who follow these principles consistently are the ones who build lasting wealth. By the end of this chapter, readers understand that making money in stocks is not mysterious. It is logical, disciplined, and achievable. The next part of the book will show exactly where to find these opportunities, how to identify value in the market, and which tools will help investors make intelligent choices. Part 2. Finding Value. Introduction. Part 2 of this book focuses on one of the most important aspects of value investing: finding companies that are worth more than their current market price. Understanding value is not enough. To succeed as an investor, you must know where to look and how to identify opportunities that others often overlook. Christopher Browne begins this section by explaining that value is everywhere, but it is not always obvious. The market can be irrational, pricing stocks too high or too low based on emotions, rumors, or short-term events. A disciplined investor looks past these distractions and focuses on the fundamentals of the business. By analyzing balance sheets, cash flow, earnings, and dividends, investors can uncover hidden gems in the market. He emphasizes that finding value is a combination of research, experience, and judgment. It is not about guessing which stock will rise tomorrow. It is about evaluating whether a company is strong, well-managed, and available at a price that offers a margin of safety. This mindset helps investors avoid speculative mistakes and build a portfolio of businesses that are likely to grow steadily over time. Another important lesson in this part is that value can appear in unexpected places. Sometimes, overlooked small companies offer greater opportunities than popular large-cap stocks. Sometimes industries that seem boring contain businesses with strong fundamentals and consistent cash flow. The value investor must remain open-minded, willing to dig deeper, and avoid being influenced by popularity or hype. Browne also introduces the tools and techniques that will be explored in this section. From financial statements to ratios and cash flow analysis, these are the instruments that allow investors to measure value objectively. By mastering these tools, you can distinguish between a company that appears attractive and one that truly offers a bargain. Finally, Part 2 sets the stage for practical investing. It moves beyond philosophy into action. Knowing how to find value is the bridge between understanding what value investing is and actually making profitable investments. By learning where to look and what to measure, investors gain the confidence to make rational decisions even when the market is emotional or chaotic. As we move to the next chapter, you will begin exploring exactly where to look for value in the stock market. Browne will show that opportunities exist in everyday businesses, overlooked industries, and even companies that others consider risky. Recognizing these opportunities is the first step in building a successful value investing portfolio. Chapter 6. Where to look for value. In this chapter, Christopher Browne guides investors on where to find opportunities to buy companies below their true worth. Finding value is not always easy, because the stock market is crowded with opinions, rumors, and hype. However, careful observation and research can reveal undervalued businesses that others overlook. Browne emphasizes that value can be found in almost every sector, but it requires discipline, patience, and the ability to ignore popular sentiment. Browne starts by explaining that the best opportunities often exist where few are looking. Large, well-known companies may attract attention, but they are usually fairly priced because everyone knows about them. Smaller or neglected companies, on the other hand, may be misunderstood or ignored by the market, creating bargains for patient investors. These overlooked companies can offer high-quality businesses at low prices, especially if the market temporarily underestimates their potential. The chapter also highlights the importance of industry knowledge. Understanding how a company makes money, the challenges it faces, and its position in the market is essential for spotting value. Investors should look for businesses with competitive advantages, loyal customers, and reliable management. These companies are more likely to withstand economic downturns and continue generating profits over time. Another point Browne makes is the role of market overreactions. Fear and pessimism can push stock prices below intrinsic value. Smart investors view these periods of negative sentiment as opportunities to buy solid companies at discounted prices. Conversely, over-optimism can make good companies expensive, and it is often wiser to wait for a better entry point. Recognizing these cycles allows investors to act rationally when others are emotional. Browne also stresses the importance of focusing on fundamentals rather than market chatter. News headlines, analyst predictions, and short-term trends rarely reflect the true value of a business. Instead, value investors rely on financial statements, earnings history, cash flow, and assets to make decisions. By looking at the numbers, not the noise, they can identify opportunities that the broader market may ignore. Finally, the chapter underscores the need for patience and discipline. Finding value is not about reacting quickly or chasing hot stocks. It is about careful research, evaluating opportunities, and waiting for the right price. This approach may seem slow compared to speculative investing, but it reduces risk and increases the potential for long-term gains. By the end of this chapter, readers understand that value is often hidden in plain sight. The key is knowing where to look, focusing on fundamentals, and avoiding the distractions of market hysteria. With these principles in mind, the next chapter will introduce the practical tools of value investing, showing how financial yardsticks can help measure a company's worth accurately. Chapter 7. Financial Yardsticks: The Tools of Value Investing. In this chapter, Christopher Browne introduces the essential tools that allow investors to measure a company's value accurately. Understanding value is one thing, but being able to quantify it is what separates disciplined investors from gamblers. These tools, which Browne calls financial yardsticks, help investors compare businesses, identify bargains, and make rational decisions. Browne begins by explaining that investing without financial tools is like navigating in the dark. The stock market can be confusing and unpredictable, but numbers provide clarity. They reveal whether a company is profitable, financially stable, and capable of sustaining growth over time. By learning how to read financial statements and apply simple metrics, investors gain a powerful advantage over the crowd. One of the first tools discussed is the price-to-earnings ratio. This ratio compares a company's stock price to its earnings per share. It helps investors determine whether a stock is cheap or expensive relative to its profits. Browne cautions, however, that no single ratio tells the full story. Investors must look at multiple indicators to form a complete picture of a company's value. The book also emphasizes the importance of the balance sheet, which shows a company's assets, liabilities, and net worth. A strong balance sheet indicates financial health and provides a margin of safety. Companies with low debt, ample cash, and valuable assets are better positioned to survive downturns and generate long-term returns. This is why Browne often says, "It's the balance sheet, stupid," highlighting its central role in value investing. Cash flow is another critical yardstick. Earnings can be manipulated through accounting practices, but cash flow reveals the actual money coming in and out of a business. A company generating consistent cash flow can reinvest in growth, pay dividends, and weather challenges. Investors should prioritize businesses with strong and predictable cash flows. Browne also discusses dividends, which are payments made to shareholders from profits. Dividends provide a tangible return on investment and indicate that a company is financially disciplined. Steady or growing dividends often signal a healthy, well-managed business. Investors can use dividends as a safety measure and as a way to compound wealth over time. The chapter concludes by reminding investors that financial yardsticks are tools, not guarantees. They provide information and guidance, but judgment and experience are essential. By combining these tools with patience, discipline, and a focus on intrinsic value, investors can identify opportunities others overlook. By the end of this chapter, readers understand that successful value investing requires both mindset and method. The next chapter will dive deeper into one of the most critical elements of analysis: the balance sheet. Understanding the balance sheet allows investors to see the true financial health of a company and spot bargains in the market. Chapter 8. It's the balance sheet, stupid. In this chapter, Christopher Browne emphasizes the critical importance of the balance sheet in value investing. He bluntly states that the balance sheet often reveals more about a company's true worth than earnings reports, press releases, or market hype. While earnings can fluctuate and be manipulated, the balance sheet provides a snapshot of a company's financial strength, liquidity, and stability. Browne explains that a strong balance sheet reduces risk. Investors should focus on companies with substantial assets, low debt, and ample cash. These businesses can survive economic downturns, reinvest in growth, and provide steady returns to shareholders. Conversely, companies with high debt or weak assets may appear profitable in the short term, but they carry hidden risks that can lead to significant losses. He highlights key components of the balance sheet that every investor should understand. Assets, including cash, inventory, property, and equipment, show what a company owns. Liabilities, such as loans, accounts payable, and obligations, show what it owes. The difference between assets and liabilities, the equity, represents the true value of the business for shareholders. By analyzing these figures, investors can estimate a company's intrinsic value more accurately than by relying solely on earnings. Browne also discusses the importance of liquidity. Cash on hand and liquid assets allow a company to meet its obligations without selling long-term investments at a loss. This flexibility is particularly important during recessions or unexpected market shocks. A company with a solid balance sheet can survive tough times, whereas one with weak financials may fail even if it appears profitable on paper. The chapter further explains that a strong balance sheet supports other aspects of value investing, such as dividends and reinvestment. Companies with financial stability can consistently pay dividends, which provide investors with tangible returns, and fund growth opportunities that increase long-term value. This combination of safety and potential growth is the hallmark of a good investment. Browne warns against being seduced by short-term earnings. A company may show impressive profits, but if it carries excessive debt or lacks sufficient assets, those profits are fragile. The balance sheet acts as a reality check, revealing whether earnings are sustainable or just a temporary illusion. Finally, the chapter reinforces the principle of margin of safety. By focusing on companies with strong balance sheets and undervalued assets, investors can buy at prices well below intrinsic value, protecting themselves against mistakes, market fluctuations, and unexpected events. By the end of this chapter, readers understand that the balance sheet is the backbone of value investing. It provides a clear view of a company's financial health and forms the foundation for identifying true bargains. With this knowledge, the next chapter will explore earnings, cash flow, and dividends, showing how these factors work together to measure a company's profitability and potential for long-term returns. Chapter 9. Earnings, Cash Flow, and Dividends. In this chapter, Christopher Browne explores three key measures of a company's financial performance: earnings, cash flow, and dividends. While the balance sheet shows what a company owns and owes, these metrics reveal how well it generates money and rewards its shareholders. Understanding these factors is crucial for value investors seeking profitable and safe investments. Browne begins with earnings, which represent the profit a company reports after expenses. While earnings are important, he cautions that they can be manipulated through accounting choices. For example, companies might defer expenses, adjust depreciation, or use other accounting techniques to make profits appear higher than they truly are. This is why savvy investors never rely solely on earnings. They must dig deeper to see if profits are real and sustainable. Cash flow is the next essential measure. Unlike earnings, cash flow represents the actual money coming in and out of a business. Browne explains that a company can report strong earnings while struggling with cash, which creates risk. Positive cash flow indicates that a company can pay its bills, invest in growth, and return money to shareholders. Investors should look for companies that generate consistent, strong cash flow over time, as this signals financial health and reliability. Dividends are another important consideration. Dividends are direct payments to shareholders from profits, and they provide tangible returns even if stock prices fluctuate. Browne emphasizes that companies that consistently pay or increase dividends often demonstrate discipline and stability. Dividends also allow investors to reinvest earnings, taking advantage of compounding over time. For many value investors, steady dividend-paying companies are the foundation of long-term wealth creation. The chapter also discusses the relationship between these three metrics. Earnings without cash flow may be misleading, while strong cash flow without reinvestment or dividends may indicate a company is hoarding resources. A combination of sustainable earnings, positive cash flow, and reasonable dividends often points to a well-managed business capable of long-term growth. Browne advises investors to look beyond short-term trends. Temporary dips in earnings or cash flow are common, but the focus should be on consistent performance over several years. A company that can generate steady profits and cash, while returning some of that to shareholders, is likely undervalued if the market has overlooked it. Finally, the chapter emphasizes patience and careful analysis. Evaluating earnings, cash flow, and dividends allows investors to estimate a company's true worth and find opportunities where price is below value. By combining these metrics with a solid balance sheet and disciplined research, a value investor can reduce risk and increase the likelihood of long-term gains. By the end of this chapter, readers understand that earnings, cash flow, and dividends are more than numbers. They are signals of a company's strength, stability, and ability to reward investors. The next chapter will warn about the dangers of relying too heavily on reported earnings alone, showing how illusions can mislead even experienced investors. Chapter 10. Beware of the earnings mirage. In this chapter, Christopher Browne warns investors about one of the most common traps in the stock market, the earnings mirage. Many investors are seduced by flashy profits, impressive growth rates, or headlines touting record earnings. But Browne emphasizes that not all earnings are created equal, and relying solely on reported profits can be dangerous. He begins by explaining that companies often use accounting techniques to make earnings appear stronger than they really are. Adjustments for one-time gains, changes in depreciation, or creative revenue recognition can distort the real picture. While these numbers may look impressive on paper, they do not always reflect cash flow, financial stability, or long-term profitability. A company may seem profitable while struggling to generate real money for investors. Browne stresses the importance of digging deeper than the headline earnings. Investors must examine how profits are generated and whether they are sustainable. Temporary spikes, unusual gains, or accounting maneuvers should never influence long-term investment decisions. Instead, value investors focus on consistent, recurring earnings backed by strong cash flow and sound management. The chapter also highlights the danger of growth at any cost. Companies may show impressive earnings growth, but if that growth comes with high debt, overextended operations, or risky business practices, it is fragile. Browne reminds readers that it is better to invest in a stable company generating steady profits than to chase companies promising explosive growth with hidden risks. Dividends, cash flow, and asset strength can serve as reality checks against the earnings mirage. A company that produces solid cash and maintains a healthy balance sheet is more trustworthy than one with inflated earnings, but weak fundamentals. By evaluating these factors together, investors can see past the illusions and identify businesses with true long-term value. Another key lesson in this chapter is skepticism. The market often rewards stories and hype over substance. A company with a sensational earnings report may see its stock price rise temporarily, but without a solid foundation, the price can fall just as quickly. Value investors maintain discipline by relying on fundamentals, not market emotions or short-term reports. Browne also introduces examples of companies that appeared highly profitable, but ultimately failed to deliver sustainable returns. These cautionary tales show that ignoring the earnings mirage can protect investors from significant losses. Understanding the difference between accounting profits and real, durable profits is essential for successful investing. Finally, the chapter reinforces the principle of patience and thorough analysis. By looking beyond reported earnings, focusing on cash flow, dividends, and balance sheet strength, and maintaining a margin of safety, investors can avoid illusions and make rational decisions. This approach allows them to buy undervalued companies with confidence and hold them for long-term gains. By the end of this chapter, readers understand that not all profits are reliable, and appearances can be deceptive. The next chapter will guide investors on how to turn this understanding into action by building and managing a portfolio that maximizes value and minimizes risk. Part 3. Building and Managing Your Portfolio. Introduction. Part 3 of this book shifts focus from finding value to putting it into action. Discovering undervalued companies is only part of the journey. To turn analysis into wealth, investors must know how to build a portfolio, manage risk, and stay disciplined over time. Christopher Browne emphasizes that even the best stock picks can fail to deliver results if they are not managed properly. Browne begins by explaining that building a portfolio is both an art and a science. It is not enough to find one or two great bargains. Investors must assemble a collection of companies that balances opportunity and safety. This requires thoughtful diversification, spreading investments across different businesses or industries, while avoiding excessive complexity that can dilute returns or create confusion. Another key principle introduced in this part is risk management. Every investment carries some risk, but the goal is to protect capital while seeking growth. Browne explains that careful selection of undervalued companies, combined with a margin of safety, reduces the chance of permanent loss. Diversification, patience, and discipline work together to manage risk effectively. Part 3 also stresses the importance of long-term thinking. Stocks are not lottery tickets. They are ownership in real businesses. Value investing rewards those who remain patient and resist the temptation to react to daily market noise. Browne encourages readers to focus on fundamentals, ignore market hysteria, and stay committed to their investment plan, even during periods of volatility. Finally, this section prepares readers for practical portfolio decisions. How many stocks should one hold? When should you buy or sell? How do you respond to market fluctuations without losing focus? Part 3 addresses these questions, providing guidelines for constructing a resilient, high-performing portfolio that can weather both short-term challenges and long-term cycles. As we move to the next chapter, you will begin with the principle of diversification. Browne will explain why spreading investments matters, how much is enough, and why too much diversification can actually hurt returns. Understanding this balance is the first step in managing a portfolio that maximizes value while minimizing risk. Chapter 11. Diversify, but not too much. In this chapter, Christopher Browne explores the principle of diversification, one of the most discussed yet often misunderstood strategies in investing. Diversification means spreading your investments across multiple stocks or industries to reduce risk. While it is a crucial tool for protecting capital, Browne warns that too much diversification can dilute returns and create unnecessary complexity. Browne begins by explaining the purpose of diversification. No matter how carefully you select stocks, some investments will perform poorly. By holding a range of companies, investors reduce the impact of any single loss. This approach provides a cushion against unexpected events, market volatility, or temporary misjudgments. Diversification acts as a risk management tool, helping preserve capital while still participating in growth opportunities. However, Browne cautions against over-diversification. Holding too many stocks can turn your portfolio into an average of market performance, eroding the benefits of selecting undervalued companies. If you own dozens of stocks, the gains from your best investments may be offset by mediocre performers. The goal of value investing is to concentrate on high-quality opportunities with real potential, not to mimic the market. The chapter also discusses the concept of focused diversification. This approach involves holding a manageable number of carefully chosen investments, usually between 10 and 20, depending on the investor's experience and resources. By limiting the number of stocks, investors can dedicate sufficient time to research and monitor each company, making more informed decisions and spotting risks early. Browne emphasizes that diversification should be guided by knowledge, not fear. Many investors spread their money too thin because they are afraid of losing. In reality, disciplined selection and understanding of intrinsic value provide a stronger foundation for reducing risk than simply owning a large number of random stocks. Each addition to the portfolio should be a deliberate choice, not an attempt to cover every possible outcome. Another key point is industry and sector diversification. Investing in companies from different industries reduces exposure to sector-specific risks. For example, a downturn in technology should not destroy a portfolio that also holds healthcare or consumer goods businesses. However, Browne warns against excessive complexity. A few well-understood sectors with solid companies are better than trying to cover every niche in the market. Finally, the chapter connects diversification to patience and discipline. Value investing requires long-term commitment, and a well-diversified but focused portfolio allows investors to withstand short-term market swings without panic. It balances risk and reward, giving investors the confidence to hold quality companies until the market recognizes their true value. By the end of this chapter, readers understand that diversification is a tool, not a cure-all. The next chapter will explore the timing of buying and selling, showing how disciplined investors can maximize gains and minimize losses without trying to predict short-term market movements. Chapter 12. When to buy and when to sell. In this chapter, Christopher Browne explains the art of deciding when to enter and exit investments, a skill critical for successful value investing. While many investors focus on predicting short-term market movements, Browne emphasizes that timing should be guided by value, not speculation or fear. Knowing when to buy or sell is about understanding a company's worth, the price you pay, and the margin of safety. Browne begins by reinforcing the principle of buying below intrinsic value. The best time to buy a stock is when it is priced significantly lower than what the business is truly worth. Market downturns, negative news, or widespread pessimism often create opportunities to purchase quality companies at a discount. Value investors do not chase stocks that are already popular or overpriced, as doing so increases risk and reduces potential gains. The chapter also explores the concept of selling. Browne explains that many investors make the mistake of holding a stock indefinitely, even when it reaches or exceeds intrinsic value. A well-timed sale allows investors to lock in profits and redeploy capital into other undervalued opportunities. Selling is not a sign of failure. It is a strategic decision that maximizes long-term returns while maintaining discipline. Browne warns against emotional decision-making. Fear, greed, and market hype often lead to buying at high prices or selling in panic during temporary declines. A disciplined investor ignores the noise and focuses on fundamentals. The value remains the anchor, guiding decisions instead of daily price movements or market sentiment. Another important lesson in this chapter is patience. Even when a stock is undervalued, the market may take time to recognize its true worth. Investors must be willing to wait for weeks, months, or even years. Rushing to sell too early or panic buying during a rally undermines the principles of value investing. Patience, combined with careful analysis, is a key determinant of long-term success. Browne also addresses the idea of partial selling. In some cases, selling a portion of holdings can lock in profits while maintaining exposure to potential future growth. This strategy balances risk and reward, allowing investors to benefit from continued appreciation while protecting capital. Finally, the chapter ties buying and selling decisions to overall portfolio management. Each decision should consider how it affects diversification, risk, and long-term objectives. By combining knowledge of intrinsic value, patience, and disciplined judgment, investors can make rational decisions that build wealth steadily over time. By the end of this chapter, readers understand that timing is not about predicting market swings, but about buying undervalued businesses and selling when value is realized. The next chapter will explain why trying to time the market is futile and how disciplined investors can achieve consistent gains without guessing short-term movements. Chapter 13. Don't try to time the market. In this chapter, Christopher Browne stresses a fundamental lesson for investors. Trying to time the market is a losing strategy. Many people believe they can predict when prices will rise or fall and use this information to maximize profits. Browne warns that this approach is based on luck, not skill, and often leads to mistakes, missed opportunities, and unnecessary risk. Browne begins by explaining that the stock market is unpredictable in the short term. Prices fluctuate daily based on rumors, news, economic reports, and investor sentiment. Even professional analysts and experienced traders rarely predict these movements accurately. Attempting to buy at the absolute low or sell at the absolute high is virtually impossible. Investors who focus on timing often end up buying high and selling low, the exact opposite of value investing principles. Instead, Browne advocates focusing on intrinsic value and long-term fundamentals. The goal is not to predict daily price movements, but to purchase strong, undervalued companies and hold them until the market recognizes their true worth. By doing so, investors avoid the stress and mistakes that come with short-term speculation. Patience and discipline replace guesswork and emotion. The chapter also discusses the psychological traps of market timing. Fear and greed drive most investors to make impulsive decisions. When prices fall, panic can trigger selling at a loss. When prices rise, overconfidence can lead to buying at inflated valuations. Both behaviors undermine long-term wealth creation. Browne emphasizes that a rational investor ignores the noise and bases decisions on careful analysis of value, not market sentiment. Another key point is the power of staying invested. Missing even a few of the best performing days in the market can drastically reduce long-term returns. Investors who try to time the market often leave these gains on the table. By focusing on quality businesses and holding them for the long term, value investors capture the compounding benefits of growth while avoiding costly mistakes caused by poor timing. Browne also introduces practical strategies to resist the temptation of timing. Setting clear rules for buying and selling, maintaining a margin of safety, and creating a disciplined portfolio plan help investors stay focused. Regularly reviewing fundamentals, rather than reacting to market noise, ensures rational decision-making. Finally, the chapter reinforces that time in the market is far more important than timing the market. The consistent application of value principles, patience, and disciplined investing produces reliable returns. Trying to predict short-term swings is a distraction that often leads to losses. Value investors succeed by focusing on what they can control, the price they pay for a business, and the quality of the company they invest in. By the end of this chapter, readers understand that market timing is unnecessary and dangerous. The next chapter will emphasize patience as one of the most powerful tools in value investing, showing how long-term thinking allows investors to benefit from compounding, market corrections, and the eventual recognition of intrinsic value. Chapter 14. Patience Pays. In this chapter, Christopher Browne emphasizes one of the most critical virtues for value investors: patience. While many investors chase quick profits or react impulsively to market fluctuations, Browne explains that long-term success depends on the ability to wait for the market to recognize true value. Patience, combined with discipline and careful analysis, allows investors to achieve consistent gains while avoiding common mistakes. Browne begins by pointing out that investing is not a short-term game. Stock prices often fluctuate wildly due to emotions, rumors, or temporary events. A company that is undervalued today may take months or even years for the market to recognize its worth. Impatient investors who sell too soon or panic during temporary declines miss out on these gains. The key is to hold quality investments until value is realized. The chapter also highlights the power of compounding over time. Small, steady gains in a well-chosen portfolio accumulate into significant wealth when given years to grow. By remaining patient, investors allow dividends, reinvested earnings, and price appreciation to work together, creating exponential returns. Browne stresses that this process cannot be rushed, and attempting to accelerate it often leads to mistakes and losses. Another important lesson is resisting emotional reactions. Fear and greed are the greatest enemies of patience. When the market falls, investors may be tempted to sell in panic, and when it rises, they may feel compelled to buy at inflated prices. Browne explains that value investors succeed by ignoring these emotions and focusing on the intrinsic worth of the companies they own. By doing so, they take advantage of market volatility instead of being harmed by it. The chapter also provides practical guidance for cultivating patience. Browne advises creating a clear investment plan, setting target prices based on value, and establishing rules for buying and selling. By following a disciplined approach, investors can avoid impulsive decisions and remain confident even during uncertain times. Regularly reviewing the fundamentals of your investments rather than daily price movements helps reinforce long-term thinking. Browne illustrates patience with real-world examples of investors who held undervalued stocks for years before the market corrected its mistakes. These stories demonstrate that patience often separates successful investors from those who fail. By waiting for the market to recognize value, disciplined investors can enjoy substantial rewards with lower risk. Finally, the chapter connects patience to the broader philosophy of value investing. It is not a strategy for quick profits, but a commitment to careful analysis, rational decision-making, and long-term growth. Investors who master patience protect their capital, avoid unnecessary stress, and allow the power of value and compounding to work in their favor. By the end of this chapter, readers understand that patience is more than a virtue. It is a practical strategy for building wealth. The next chapter will reinforce the importance of ignoring market noise, showing how disciplined investors can remain focused on value despite distractions and short-term fluctuations. Chapter 15. Ignore the noise. In this chapter, Christopher Browne emphasizes the importance of tuning out the constant chatter and distractions of the stock market. News headlines, analyst predictions, market rumors, and short-term price swings can overwhelm even experienced investors. Browne argues that focusing on these distractions leads to poor decisions, while disciplined investors who ignore the noise achieve better long-term results. Browne begins by explaining that the stock market is full of information, much of it irrelevant or misleading. Daily reports on stock prices, economic indicators, and company news often create anxiety, confusion, or overconfidence. Many investors react impulsively to this noise, buying or selling without considering the fundamentals of the business. This behavior often results in losses, missed opportunities, and unnecessary stress. The chapter also highlights the importance of focusing on intrinsic value. Value investors measure a company's true worth using balance sheets, earnings, cash flow, and dividends. When decisions are based on fundamentals rather than daily fluctuations or sensational headlines, investors can act rationally and confidently. Ignoring the noise allows them to recognize bargains and make decisions that are grounded in reality rather than emotion. Browne stresses that market fluctuations are normal and often temporary. A stock may rise or fall sharply due to panic, speculation, or short-term events, but these movements rarely reflect a company's long-term prospects. By maintaining focus on the fundamentals, investors can identify opportunities during periods of fear and avoid overpaying during periods of hype. Noise becomes irrelevant when the focus remains on value. Another key lesson is the role of discipline in ignoring the noise. Browne suggests creating a clear investment plan, setting target prices based on intrinsic value, and establishing rules for buying and selling. By following this plan, investors avoid reacting to every piece of news or market trend. Discipline turns a potentially chaotic investing experience into a rational, measured process that maximizes returns and minimizes mistakes. The chapter also highlights psychological benefits. Ignoring the noise reduces stress and emotional reactions. Investors who are not constantly reacting to headlines can think clearly, remain patient, and focus on long-term strategies. Browne emphasizes that emotional control is as important as financial knowledge in successful investing. Finally, Browne connects this lesson to the broader value investing philosophy. Investing is not about following the crowd or reacting to short-term events. It is about disciplined analysis, rational decision-making, and long-term thinking. By ignoring the noise, investors can maintain focus, avoid costly mistakes, and allow the power of patience, compounding, and intrinsic value to work in their favor. By the end of this chapter, readers understand that noise is a distraction, not guidance. The next part of the book will explore the mindset of a successful investor, including the psychology of investing, lessons from the masters, and why value investing works over the long term. Part 4. The Value Investor's Mindset. Introduction. Part 4 of this book shifts focus from technical tools and portfolio management to the most important element of successful investing: mindset. Christopher Browne explains that understanding value, analyzing financial statements, and building a diversified portfolio are essential, but without the right psychological approach, even the best strategies can fail. Browne begins by emphasizing that investing is as much a mental discipline as it is a financial one. Fear, greed, impatience, and herd mentality often lead investors to make mistakes, regardless of their knowledge or experience. Developing the mindset of a value investor involves controlling emotions, thinking independently, and staying committed to principles even when the market behaves irrationally. This part introduces key lessons on how psychology influences investment decisions. For example, panic during a market downturn can cause premature selling, while overconfidence in a rising market may tempt investors to overpay for a stock. Understanding these psychological tendencies allows investors to recognize when their decisions are being driven by emotion rather than rational analysis. Browne also explains the importance of learning from successful investors. Studying the strategies, behaviors, and mindset of masters like Benjamin Graham and Warren Buffett helps shape one's own approach. Their focus on intrinsic value, patience, and discipline illustrates that investing success is not about guessing market movements, but about thoughtful, principled decision-making. Finally, Part 4 connects mindset to the practical application of value investing. A strong mindset reinforces patience, discipline, and the ability to ignore market noise. It ensures that investors remain focused on long-term goals, maintain emotional control, and act consistently, even when the market is chaotic or tempting shortcuts appear. As we move to the next chapter, we will explore the psychology of investing in detail. Browne will explain how emotional biases, market pressures, and cognitive errors influence decision-making, and how developing the right mindset can help investors overcome these challenges and achieve long-term success. Chapter 16. The Psychology of Investing. In this chapter, Christopher Browne delves into the mental and emotional aspects of investing, explaining why psychology is as important as financial analysis. The way investors think, react, and perceive risk often determines their success more than the numbers on a balance sheet. Emotions like fear, greed, and overconfidence can lead to impulsive decisions, eroding potential gains. Browne emphasizes that mastering the mind is essential for long-term value investing. Browne begins by highlighting fear as a major obstacle. Many investors panic during market downturns, selling quality stocks at a loss simply because prices are falling. This behavior is often irrational because temporary declines rarely reflect the intrinsic value of the underlying business. Instead, disciplined investors view market fear as an opportunity to buy undervalued stocks, capitalizing on the emotional mistakes of others. Greed, on the other hand, can be equally dangerous. When stock prices soar, investors may feel compelled to buy at inflated valuations, hoping to ride the trend higher. Browne warns that chasing hot stocks driven by hype often leads to losses when the market corrects itself. Value investing requires resisting this temptation and focusing on companies that are trading below their true worth, even if they appear less exciting in the short term. Another critical psychological trap Browne discusses is overconfidence. Investors often overestimate their knowledge or ability to predict market movements. This can lead to excessive trading, poor diversification, or ignoring warning signs in a company's fundamentals. Humility, combined with careful analysis and a disciplined approach, is essential for avoiding these mistakes. Browne also addresses the herd mentality. Many investors follow popular trends, influenced by media, analysts, or friends. This behavior often results in buying high and selling low, the opposite of value investing principles. Independent thinking, guided by careful evaluation of intrinsic value, allows investors to act rationally and avoid being swept away by market sentiment. Patience and long-term thinking are central to overcoming psychological challenges. Browne stresses that value investing is not about quick wins, but about steady wealth accumulation. By focusing on fundamentals, ignoring short-term noise, and resisting emotional impulses, investors can achieve consistent returns over time. Finally, Browne emphasizes the importance of self-awareness. Understanding personal biases, emotional triggers, and tendencies helps investors make rational decisions. Keeping a disciplined investment plan, reviewing decisions carefully, and learning from mistakes strengthens psychological resilience and enhances long-term success. By the end of this chapter, readers understand that psychology plays a critical role in investing. Emotions can amplify risk or opportunity, and mastering them is essential for value investing. The next chapter will show how learning from the masters, particularly Graham and Buffett, can reinforce these psychological lessons and provide practical guidance for successful long-term investing. Chapter 17. Learning from the Masters, Graham and Buffett. In this chapter, Christopher Browne explores the lessons investors can learn from two of the greatest practitioners of value investing, Benjamin Graham and Warren Buffett. Their approaches, rooted in discipline, patience, and rational analysis, provide a blueprint for successful investing that transcends market trends and speculation. Browne emphasizes that studying their methods is as much about mindset as it is about technique. Browne begins with Benjamin Graham, often called the father of value investing. Graham's philosophy focused on buying stocks at prices below their intrinsic value, ensuring a margin of safety. He emphasized rigorous analysis of financial statements, balance sheets, and cash flow, and warned against following market sentiment. Graham's principles were grounded in logic and mathematics, reducing emotional decision-making and protecting investors from overpaying for risky assets. The chapter highlights Graham's famous concept of Mr. Market, a metaphorical figure representing the stock market's mood swings. Browne explains that Graham taught investors to see market fluctuations as opportunities rather than threats. When Mr. Market is irrationally pessimistic, investors can buy undervalued stocks at attractive prices. When he is overly optimistic, it may be wise to sell or avoid overpaying. Understanding this mindset helps investors act rationally, while others are driven by emotion. Next, Browne examines Warren Buffett, Graham's most famous student and one of the wealthiest investors in history. Buffett built on Graham's principles, but added his own emphasis on quality businesses. He looks for companies with durable competitive advantages, strong management, and predictable earnings. While valuation remains critical, Buffett focuses on buying great businesses at fair prices rather than merely cheap stocks. This combination of value and quality has been a hallmark of his long-term success. Browne stresses that both Graham and Buffett share key traits: patience, discipline, and long-term thinking. They resist market hysteria, avoid speculation, and focus on fundamentals. Studying their examples teaches investors how to approach the market with rationality, manage emotions, and maintain a consistent strategy. Their records also illustrate that success in investing is not about quick gains, but about steady, thoughtful accumulation of wealth over time. The chapter also discusses practical lessons for everyday investors. Browne advises keeping emotions in check, evaluating companies carefully, and maintaining a margin of safety. He highlights that one does not need to be a genius or have insider knowledge to succeed. Following the principles of Graham and Buffett consistently can produce reliable results even in unpredictable markets. Finally, Browne connects these lessons to mindset. Learning from the masters reinforces the psychological traits necessary for value investing: patience, emotional control, independent thinking, and focus on intrinsic value. By internalizing these principles, investors can make smarter decisions, avoid common pitfalls, and build wealth over time. By the end of this chapter, readers understand that studying Graham and Buffett provides both technical tools and psychological guidance. Their examples demonstrate that disciplined, patient, and rational investing consistently outperform speculation. The next chapter will explain why value investing works, exploring the underlying principles that make this approach reliable over the long term. Chapter 18. Why Value Investing Works. In this chapter, Christopher Browne explains the fundamental reasons why value investing is a reliable long-term strategy. While markets may be unpredictable in the short term, buying undervalued companies and holding them patiently consistently produces superior returns. Browne emphasizes that this approach works because it combines rational analysis, emotional discipline, and the natural growth of business fundamentals over time. Browne begins by noting that value investing is rooted in reality rather than speculation. Investors focus on the intrinsic worth of a business, not the latest trends, market hype, or price movements. By evaluating assets, earnings, cash flow, and dividends, value investors make decisions based on tangible data rather than guesses or predictions. This rational, methodical approach reduces the risk of overpaying and increases the likelihood of long-term gains. The chapter also highlights the concept of the margin of safety. Buying a stock below its intrinsic value provides protection against errors, market volatility, and unforeseen events. Even if the market temporarily misprices a company or a prediction does not fully materialize, the margin of safety ensures that losses are minimized. This principle is central to why value investing consistently outperforms speculative approaches over time. Another reason value investing works is the power of patience. Browne explains that the market does not always recognize a company's true value immediately. Undervalued stocks may remain ignored or depressed for months or years, but disciplined investors who hold them patiently eventually benefit as the market corrects its pricing. The combination of intrinsic value and patience creates compounding wealth, which is often underestimated by casual investors. Browne also emphasizes the role of psychological discipline. Value investing works because it encourages rational decision-making, independent thinking, and emotional control. Investors who adhere to fundamentals rather than chasing market trends avoid the common mistakes of fear and greed. By remaining focused on real value, they benefit when the broader market overreacts in either direction. The chapter highlights historical evidence as well. Over decades, studies show that stocks purchased below intrinsic value tend to outperform speculative investments. Companies with strong fundamentals, undervalued assets, and consistent earnings provide higher returns to patient investors, even when market sentiment is volatile or irrational. This track record reinforces the reliability of value investing principles. Finally, Browne connects these concepts to the investor's mindset. Success comes from combining careful analysis, patience, and discipline. By understanding why value investing works, investors gain confidence to remain steadfast during market fluctuations, take advantage of opportunities during periods of fear, and avoid the temptation to chase short-term gains. By the end of this chapter, readers understand that value investing succeeds because it is rational, disciplined, and grounded in real business fundamentals. The next and final section will bring all these lessons together, emphasizing the importance of staying the course and the rewards of consistent, principled investing. Chapter 19. Stay the Course. The Rewards of Value Investing. In this final chapter, Christopher Browne emphasizes the ultimate lesson of value investing, the power of consistency and staying the course. While finding undervalued stocks, analyzing balance sheets, and managing a portfolio are essential skills, the greatest rewards come to those who commit to the long-term principles of value investing and resist the temptations of short-term thinking, market panic, or speculation. Browne begins by reminding readers that investing is a marathon, not a sprint. Markets are inherently volatile, and short-term fluctuations are inevitable. Prices rise and fall for reasons often unrelated to a company's true worth. By maintaining discipline and sticking to a carefully crafted investment plan, value investors can navigate these fluctuations without panic, taking advantage of temporary market irrationality rather than being hurt by it. The chapter highlights the importance of patience and perspective. Browne explains that many investors give up too soon, abandoning their positions during market downturns or selling undervalued stocks before the market recognizes their true worth. Staying the course allows compounding to work, dividends to accumulate, and the market's eventual rationality to reveal the value already present in the underlying businesses. This patience often separates successful investors from those who fail to achieve their financial goals. Browne also stresses emotional resilience. Fear, greed, and impatience are constant challenges, even for experienced investors. Value investing rewards those who maintain composure during market hysteria, avoid herd mentality, and make decisions based on careful analysis rather than emotion. By ignoring noise and focusing on fundamentals, investors reduce the likelihood of costly mistakes and increase their chances of long-term success. The chapter reinforces the rewards of staying invested in quality businesses. Companies with strong fundamentals, consistent earnings, and sound management tend to grow over time, even when market sentiment fluctuates. Investors who remain committed to these principles benefit from both capital appreciation and steady dividend income, creating a compounding effect that builds wealth reliably over the years. Browne concludes by reminding readers that value investing is not about chasing trends, making quick profits, or trying to beat the market in the short term. It is a disciplined approach built on understanding intrinsic value, maintaining a margin of safety, exercising patience, and controlling emotions. Those who adhere to these principles consistently are rewarded not just with financial gains, but with the confidence and peace of mind that comes from rational, informed investing. Finally, Browne leaves readers with a lasting principle. Investing success is achieved by doing what others often fail to do: thinking independently, remaining disciplined, and staying focused on long-term value. By embracing these lessons, investors can navigate uncertainty, capitalize on opportunities, and enjoy the rewards of thoughtful, principled investing. With this chapter, the journey of the little book of value investing comes full circle, connecting analysis, strategy, and mindset. Readers now have the knowledge and perspective to identify value, manage a portfolio, control emotions, and most importantly, stay the course to achieve lasting financial success.